How a company gets listed on the market. Hey there, welcome back to Wall Street for All. So far, we've talked a lot about stocks and companies. But have you ever wondered, how does a company actually get on the stock market? Today, we're talking about the road to going public. Step 1. Growth and preparation. Let's say a private company, like a tech startup, is growing fast. They want to raise money to build more products, hire employees, or expand globally. They need big funding, and one way to get it is by going public. Step 2. The IPO, Initial Public Offering. IPO stands for Initial Public Offering. It's the moment a private company sells stock to regular people for the first time. It's a big deal, and often celebrated like a business birthday. Step 3. Filing with the SEC. To go public, a company must file paperwork with the Securities and Exchange Commission, the SEC. They explain how their business works, how much money they make, and the risks involved. This makes investing transparent and safer for the public. Step 4. Choosing an exchange, NYSE or Nasdaq. The company decides where to list its stock, usually either the New York Stock Exchange or Nasdaq. NYSE is more traditional, big names like Coca-Cola and Walmart. Nasdaq is digital, tech giants like Apple and Google. Step 5. The big day, going public. On IPO day, the company picks a stock ticker symbol, like AAPL for Apple or NFLX for Netflix. They ring the opening bell, and trading begins. Investors around the world can now buy shares. Why does this matter to you? IPOs can be exciting, but also risky. Prices may jump or fall fast. Some investors like to get in early, while others wait to see how the company performs. Understanding the IPO process helps you invest with confidence. So the next time you hear the news say a company is going public, you'll know exactly what that means and how it happens. Private company grows files. With SEC launches IPO lists on NYSE or Nasdaq rings the bell and goes public. It's a journey, and now you know the map. Who regulates the market? SEC and FINRA. We're answering a really important question. Who's in charge of making sure the stock market isn't just a big mess? Let's talk about the people who make the rules and keep things fair in the market. Meet the SEC, Securities and Exchange Commission. The SEC is a government agency created in 1934. After the stock market crash of 1929, people demanded better rules and protections. The SEC's job is to protect investors and keep the market honest. What does the SEC do? Here's what the SEC does. Reviews company filings before IPOs. Makes sure companies tell the truth to investors. Investigates fraud, insider trading, or shady deals. Enforces laws and can issue fines or press charges. Basically, the SEC is the referee of the stock market. What is FINRA? The Financial Industry Regulatory Authority, or FINRA, isn't a government agency. It's a private group that watches over brokers and trading firms. If you buy or sell stock using a brokerage, like Robinhood, Schwab, or Fidelity, FINRA helps make sure those companies play fair. SEC versus FINRA. What's the difference? Think of it like this. SEC oversees companies and the market overall. FINRA oversees brokers and trading behavior. They work together to keep investors protected and the system running smoothly. How they protect you. Both the SEC and FINRA catch scams and fraud. Make sure investors have the info they need. Require clear reporting from public companies. Give you a place to file complaints if something feels wrong. The goal? Make the market safer for you. So no, the stock market isn't a free-for-all. It's got some pretty serious grown-ups keeping watch. And that's a good thing. Quick recap: SEC, Government Watchdog, FINRA, Broker Rule Enforcer. Both protect investors and make sure the game is fair. When you What are indexes? Dow, S&P 500, Nasdaq. We're going to explain something you've probably heard on the news, but never quite understood. The Dow, the S&P 500, and the Nasdaq. What are they and why do they matter? What is a stock market? Index? A stock market index is basically a group of companies tracked together to show how a part of the market is doing. Think of it like a class average at school. It tells you how the whole class is performing, not just one student. The Dow Jones. The Dow Jones Industrial Average, or just the Dow, is made up of 30 major U.S. companies. These are big established businesses like Apple, Coca-Cola, and Boeing. It's one of the oldest and most talked about indexes, but it doesn't cover the whole market. It's kind of like checking in on 30 of America's most famous brands to get a sense of what's happening. The S&P 500. The S&P 500 includes 500 of the largest U.S. companies from all different industries: tech, healthcare, energy, finance, you name it. It's considered one of the best overall measures of the U.S. stock market's health. So when people say, "the market was up today," they often mean the S&P 500. The Nasdaq Composite. The Nasdaq Composite includes thousands of companies, but it's known for being tech-heavy, full of companies like Apple, Amazon, Google, Meta, and Tesla. If you want to know how the tech world is doing, look at the Nasdaq. It's a good snapshot of the digital economy. Why indexes matter. Indexes help us see how the market is doing overall. Compare how different companies or sectors are performing, track market trends over time. Investors even use index funds to invest in all the companies inside these indexes at once. Quick recap. Dow, 30 big companies. S&P 500, 500 large companies. Broad market. Nasdaq, thousands of companies, tech focus. Think of indexes as the report cards of the stock market. How technology changed the market. We're diving into how technology transformed the stock market, from loud trading floors to apps in your pocket. Back then, the old-school trading floor. Back in the day, if you wanted to buy a stock, you had to call your broker, and they'd place a trade on a crowded trading floor. It was noisy, fast, and full of hand signals. It wasn't exactly beginner-friendly. Now, you can trade from your phone. Today, you can invest with just a few taps on your phone, using apps like Robinhood, Fidelity, Schwab, and many others. You can see live prices, track your stocks, and even buy fractional shares, all from your couch. Technology has made investing more open and accessible to everyone. The rise of online brokers. Online brokers changed the game. No more calling someone, no more $50 trading fees. Now most platforms offer commission-free trades, letting you invest without big upfront costs. And many offer educational tools, so you can learn as you go. Fractional shares, a game changer. Want to own Amazon but don't have $3,000 for a full share? No problem. With fractional shares, you can buy just $10 worth of stock. It's like ordering one slice instead of the whole pizza. This lets more people invest in big companies, even with small budgets. AI, algorithms, and fast trading behind the scenes. Computers and algorithms handle millions of trades per second. This is called algorithmic trading. It makes markets faster, but can also make them more volatile at times. More access, more responsibility. With great access comes great responsibility. Just because it's easy to invest doesn't mean you should rush in. Learn first and build a smart plan. Technology opened the doors, but your mindset still matters most. Quick recap. Then, loud trading floors, brokers. Now, apps, instant trades. You can start small, learn as you go. Technology empowers smart investors. Technology has made Wall Street feel a lot closer to Main Street. You don't need a suit or millions of dollars, just curiosity and a bit of confidence. Busting myths about the stock market, we're doing something a little different. Let's bust some of the biggest myths about the stock market. Myth number 1. The stock market is just gambling. Let's clear this one up right away. Gambling is based on chance. The stock market is based on businesses and their performance. Over time, companies grow, earn profits, and pay dividends. It's not luck. It's investing in real-world success. Yes, there are risks. But smart investors do research and invest with a long-term mindset, not a roulette wheel. Myth number 2. You need to be rich to invest. This used to be true, but not anymore. With modern apps, you can start with as little as $5 or $10 thanks to fractional shares. You don't need thousands of dollars to get started. You just need to start small and be consistent. Myth number 3. You have to be a genius to understand it. You don't need a finance degree. You just need the right mindset and tools. There are tons of free resources, like this channel, to help you learn the basics step by step. Investing isn't about being the smartest. It's about being patient, informed, and steady. Myth number 4. You can get rich quick. Sorry, but the stock market isn't a shortcut to riches. Chasing fast money usually leads to fast losses. Most wealth is built slowly over time, through consistent investing and compound growth. The real magic of investing is in years, not days. Quick recap. It's not gambling. You don't need to be rich. You don't need to be a genius. It's not a get-rich-quick scheme. It's about time, patience, and learning. Don't let these myths scare you away. The market is for all of us, and you're already ahead by learning the truth. How it affects real people. We've covered what the stock market is and how it works. But today, we're getting personal. Let's look at how the stock market affects you, me, and everyday people. Jobs, your work, and the market. Most companies that are listed on the stock market employ millions of Americans. If the market's doing well, companies often grow, hire more people, or offer better pay. When markets crash, companies may cut costs, and that can mean layoffs. So yes, your job can be tied to the stock market, even if you don't own a single stock. Retirement, 401ks, and pensions. Most retirement plans, like 401ks or IRAs, invest your savings into the stock market. When the market grows over time, your savings grow too. Short-term dips can hurt, but staying invested over the long run is the key. Even if you don't watch the stock market daily, your future depends on it. Your community. Local businesses. Big companies on the stock market also support local communities. They open stores, hire local workers, sponsor schools, and support nonprofits. Even small businesses feel the ripple. When the economy grows, people spend more, and local businesses thrive too. Prices, groceries, gas, and more. Market trends often influence prices for goods and services. Inflation, interest rates, and economic conditions, all tied to the stock market, affect what you pay at the store or earn from savings. You may not see it directly, but it's happening behind the scenes, every day. Loans and credit, how much you can borrow. When markets shift, so do interest rates. That means the cost of loans, mortgages, and even credit cards can change. A weaker market might lead to higher rates, making borrowing more expensive. Quick recap. Your job can be affected. Your retirement depends on market. Growth. Your community benefits from strong companies. Your prices and loans are influenced too. So even if you never invest a penny, the stock market is already a part of your life. Understanding the market isn't just about investing. It's about being informed. It helps you make smarter decisions. Final thoughts. Plus, how to keep learning. Hey friends, I'm so proud of how far you've come. Whether you're new to the stock market or just looking to understand more, you made it. What you've learned. Why the stock market matters. What stocks are and how companies raise money. How the market works and where trading happens. What influences prices. How all this impacts your daily life. You now understand the core ideas: stocks, companies, exchanges, indexes, and how it all connects to real life. That's a big deal. Many people invest without truly understanding these basics. But you do. The right mindset moving forward. Building wealth and financial confidence takes time. The market isn't a get-rich-quick scheme. It rewards knowledge, discipline, and long-term vision. Remember, you don't need to be rich, or a genius, or glued to the news. You just need to be curious and consistent. Where to learn more? There are so many great ways to keep learning. Find what works for you. Reading, watching, listening. You've already taken the hardest step. Starting. Your next steps. Keep exploring content, like this channel. Open a mock investment account to practice, learn about risk and diversification. Explore your own financial goals. You don't have to invest today. But the more you learn, the better prepared you'll be when you're ready. Final words from Wall Street for All. I created Wall Street for All to break the myth that the stock market is just for the wealthy or the Wall Street insiders. It's for all of us. For teachers, for parents, for artists, for truck drivers, for anyone who wants a more secure future. So keep learning, stay curious, ask questions, and remember, the market may look complex, but it's just made of people, businesses, and ideas. You did it! Thank you for watching. You're officially ready to move beyond the basics. I'll see you in our next series, where we'll explore how to actually start investing. Until then, take care and take charge.